Aloha and welcome to the KupunaWiki radio show. This month we're rounding out our series on real estate. And in studio we have Tiffany Davies, the Vice President Regional Account Executive at Investment Property Exchange Services. And we're going to be talking about 1031 exchanges. KupunaWiki is Hawaii's senior resource. We talk to the best local professionals in the state regarding topics such as real estate, senior housing, estate planning, finance, and health, so that our Kupunan families can find the best resources in the midst of a life transition. We strive to make sure our seniors are informed and supported every step of the way. Thanks for joining us today. I'm Brandon Lau.
I'm Andrew Leon,
your host for the KupunaWiki radio show.
Our title sponsor for today is Cheney Brooks Choice Advisors, providing you with the best real estate information so you can make the most informed decisions. As they like to say, real estate is about choice. To contact them, call 753-9033.
And now we have our real estate tip of the week, brought to you by Cheney Brooks Choice Advisors.
Want to save at least $1,000 a year? Well then, clear out your rented self-storage unit. Nearly 1 in 10 U.S. households rents a self-storage unit, and most are filled with stuff people probably forgotten they have. Here's how you should do it. Don't keep stuff just in case you'll need it. Less is more, and if you simply just can't part with these items, make sure that your stuff is adequately insured in the event of a loss. Be sure to review your rental agreement. What losses will the storage facility cover, and whether you might need supplemental insurance. Most self-storage facilities require you to have insurance coverage for the full replacement costs of the contents of the unit. If you already have homeowners insurance or renter's insurance, check to see if your policy provides off-premise protection for properties in the case of theft, fire, flood, and other disasters.
For more information on how to store your belongings, or maybe a bigger house for your belongings,
Yes.
Contact Cheney Brooks Choice Advisors, 753-9033. Again, today in the studio we have Tiffany Davies, Vice President, Regional Account Executive at IPS Investment Property Exchange Services. Welcome, Tiffany.
Welcome, thank you.
Thanks for being on the show. Well, IPS has been around for quite a while, and we know that they've been a staple in the 1031 exchange industry, but you've also been involved in 1031 exchanges for quite a while, right?
Yeah, about 15 years in exchange.
And how did you get into this particular service?
So my background is I started off in the title and escrow industry, about 20 years old. So working just at the title company, working with a lot of investors. That was really my knack back then, if I'm going back 20 years. And then I transitioned into exchange once I moved out here to Hawaii.
Okay.
And it was a great move for me. It really challenged me to learn a lot more about what I'm doing.
Exchanges. Now, for our listeners who may not know what an exchange is, maybe we can give a real simple definition. What is a 1031 tax-deferred exchange?
A 1031 exchange is a way to sell investment property and buy replacement property and defer the capital gains tax that would normally be due.
And so this has to do with not just real estate, but most of the time we are talking in particular about real estate.
Yep, just real estate.
Yeah. So the 1031 exchange, a lot of times would deal with investors because they have investment property and maybe they want to sell it for one reason or another, but they're looking at the tax liability and they're like, uh-oh, should I sell it? And if I do, is there a way to defer paying this large tax bill, this year? And I guess that's where they start thinking about the 1031 exchange option.
Yep. A lot of people, once they sit down with their CPA, they realize what that tax hit is going to look like. And just to throw out there, I'm not a CPA, I'm not an attorney, so I can't give specific advice. But I usually am the first person that you're going to talk to when you're considering an exchange. And we talk about what does it look like if I just do a cash out sale and pay my tax versus what does it look like if I do an exchange and keep that money working for me and my heirs.
I like when you said working for me, because I think we want our investment dollar to go as far as possible, right? And in Hawaii, we know that the INA is so important.
Yes.
And for many reasons, but one of which it is very expensive to own land.
Expensive.
So for a person who had purchased the property back 30, 40 years ago, they may have experienced a doubling up in value, and that's a huge gain, right? So again, they're trying to determine, okay, how can I allow my investment dollar to go as far as possible, maybe preserve some of that for my kids or the kids' kids, right? And again, that's where a 1031 exchange comes into play. What are some maybe situations that you've experienced where somebody has benefited from an exchange and it's worked out really well for them?
Yeah, I could come up with a lot of stories, but one of my favorite ones is because it was a little bit outside of the box. My friend's dad was selling 2 properties, or had wanted to list 2 properties in California. So both of those properties collectively, the exchange funds coming in would have been about $350,000. He had a good CPA. His CPA told him he needed to do an exchange.
Okay.
And it wasn't just about the taxes at that point. It was about him getting new depreciation. So, residential properties, you can depreciate them for 27 and a half years, commercial 39 years. So what he did is he sold those 2 properties in California, and then he rolled it into something here locally and bought for about $1 million. So he had $700,000 of new depreciation he's able to take moving forward.
Right.
And that worked out really nicely for their family.
So in that case, I mean, he had a tax motivation,
Mm-hmm.
not just to avoid taxes, but to benefit from more depreciation,
Right.
right? So that whatever income that he was earning could be reduced, or the taxable income, I should say, because he had something to depreciate.
Right. It's like a credit every year that an investor gets, right? That depreciation, they really like that.
Right.
And you can do that as long as there's improvements on the land.
Okay. And they must have been empty nesters, so yeah.
They were, yeah. In fact, their goal was to get a property here because they had grandchildren here.
Mhm.
And they actually found something that was like 2 houses on top of each other. So they're able to stay in the bottom portion, and then they rent out the top portion.
So that's interesting. Now, in that scenario, it's a little more complex,
Mm-hmm.
but the exchange didn't preclude them from eventually being able to use one portion of that residence
Right, yeah.
later on.
Yeah, their CPA
Yeah.
was absolutely fine with it. They were even fine with them not renting out the bottom portion. They could leave that open for them to use personally. But really, it comes down to how the CPA files it on the taxes.
Right.
Mm-hmm. But it was a very powerful move. And then now they also have 2 rental units as well.
Right, which is great cash flow
Mm-hmm.
for their latter years.
Right.
Right. Well, maybe we can just get into a little bit of the mechanics, maybe the so-called rules of an exchange, just so that our listeners have an idea of what they have to plan for.
Yeah. Well, the most important thing is working with somebody like yourself who understands exchanges and would add that 1031 exchange addendum into the property when they're getting, at least to disclose it when you're getting ready to sell, right? Which puts the buyers on notice that there's no delay or extra expense. They plan to do this 1031 exchange. And then basically you're listing that property. They're looking for a buyer. When they get that buyer and escrow has been opened, that's when we would get these exchange documents in place. We do that before closing, so that's really important that we get those documents in place before closing. Closing takes place. Instead of those funds going to them in the form of a check, they're coming to us as the qualified intermediary. We're holding them. And then the client or you instruct us as to what to do with them on the replacement property, right? So you're looking out there looking for replacement property, and then it's just a smooth transition between what they've sold and what they're purchasing. But from the day that they actually close escrow on what they're selling, they have 45 days to identify. And that 45 days is a solid 45 days. You're locked into that list that you've identified by day 45.
How many properties can you identify?
Well, you can identify up to 3. You basically have to pick a rule. So you're either going to pick the 3 property rule or the 200% rule. Most people here in the islands are using the 3 property rule because our values are so high. So they can identify 3 properties, any value. They just need to close on 1 and use up all those exchange funds.
Right. And on the outside close date of the replacement property, what kind of time frame are they bound by?
They've got to close on those replacement properties within 180 days. So 45 days is the first marker, then they have an additional 135 days to close.
And I believe there may be some detail as far as the amount that they'd have to exchange into to avoid paying capital gains tax. And what does that look like?
So what that is basically I tell clients it's to keep it really clean in our minds is just sales price for sales price, right? Sales price for sales price and debt for debt. But the debt gets a little confusing. So you just have to look at the sales price. Whatever you're selling for is ideally what you should be buying for. And if you're selling for $1 million, you should be buying for close to $1 million. You can always buy down a little bit, but that really becomes a question of, if you're going to buy down by too much, sometimes it's better off to just not do an exchange.
Right.
That's why we really rely on the CPA.
Right. And from what I understand, if you buy down, let's say you're selling a property which is your current investment for $1 million, but you buy down to something that's $800,000. Without getting too complicated, that $200,000 could be taxable.
That's right.
Right. And again, like you're saying, is it worthwhile in that case to do an exchange? And that's where you have to consult with your CPA or tax advisor and really run the numbers.
That's right.
Right.
Absolutely.
So in theory, somebody may be asking the question, well, why is there an exchange in the first place? What's the IRS thinking? Don't they want the tax dollars, right? And I guess in theory it's, well, as long as you're putting your investment dollars into productive use, that's a good thing.
Yeah,
Right? So
it spurs the economy.
It spurs the economy, keeps things going, you're reinvesting the money.
Right.
So for that, they're so-called rewarding the investor,
Mm-hmm.
right? And they're not saying you're going to get away from paying taxes. They're just saying you're deferring it
Yeah.
into that new investment
Right.
property.
We call it swap until you drop.
Swap. Swap each other. Well, hopefully that explanation wasn't too complicated, but I like the swap until you drop theory.
I know. Sorry.
But we want to hear more examples and stories of how a 1031 exchange might be beneficial to our listeners and Kupuna. So we'll hear more about that right after this commercial break.
Welcome back. If you're just joining us, we have Tiffany Davies, Vice President, Regional Account Executive at Investment Property Exchange Services. First segment, great explanation about what an exchange is. Let's talk about how seniors can take advantage of it, because chances are most of them have bought their homes decades ago,
Mm-hmm.
and they've accumulated a good amount of equity, and maybe it's time for them to maybe downsize or maybe they've downsized into another property, but they still have the original, right? You brought up the great point about depreciation.
Mm-hmm.
Maybe most of them have already depreciated their property, and having new depreciation definitely helps. What options are there, like in terms of can they sell one investment and pick up two? Like, let's just say, because they can't find something equal value to it.
Yes.
Can they pick up multiple properties that equal the same amount? Will that qualify?
Absolutely. Yeah, there's no limit to what you can sell or to what you can buy. So you could sell multiple and buy one, or you could sell one and buy multiple. There's
Okay.
no limit.
Okay.
Mm-hmm.
And obviously it's like-kind property.
Yes.
Can you kind of dive into that? What is like-kind property?
Yeah, so like-kind property, really, I say dirt for dirt, real estate for real estate. So some people, I'll get a call every once in a while, can I buy a business? Unfortunately, you can buy the land underneath the business, right? But really you can sell a condo and you can buy a home. You could sell a home and buy vacant land. You could sell vacant land and buy commercial or industrial. So really, as long as it's real estate.
As long as it's real estate. Okay. And what other exchange options are there in terms of, let's just say we heard of, there's a reverse exchange that's also an option. Can you dive into a little bit about that?
Yeah, so we do, regular forward exchanges is really the bulk of our business, but then we have another division that really concentrates on reverse exchanges and construction exchanges. But our most popular would be the reverse exchange. We've been in a really fast-moving market, so people have been finding their replacement properties before they've even attempted to sell their properties. So we have some investors that are able to make it happen, and we do a lot of these at IPX. But basically, in a nutshell, it's where you're still doing an exchange. You found your replacement property first. You're going to move forward with that purchase. And then when you close escrow on that purchase, you're going to have 45 days to identify what you want to sell, because some investors want multiple properties. And you have 180 days to get that property sold. Yeah. And that 180 days is set in stone. It's immovable.
Okay.
And that's a safe harbor exchange, reverse exchange.
That's right.
Is there any chance of having a little more time?
Yes. So something that's really come down the pike recently would be the non-safe harbor reverse exchange. And for an additional fee, we are doing those at IPX, but that would be where you expect that you're going to move outside of that 180 days to sell.
Right.
And you can do this type of exchange. We take on a little bit more liability in that, so we charge an additional fee, but it is possible. We have seen clients do them.
It gives the client more flexibility and not the pressure of,
Needing that
needing that
180 days.
Correct.
Mhm.
You mentioned a little bit about fees. What's your typical fee structure for a regular exchange, and maybe you can compare that to reverse exchange?
Yeah, so our fees are really reasonable at IPX 1031, and I think we're real competitive with everybody here locally. Our fee to sell a piece of real estate under $2 million would be $850 on the relinquished property, and then we charge $200 for each replacement.
Mm-hmm.
On a reverse exchange, those start out at about $5,500. If it's an all cash purchase, I can usually give a little bit of a discount there, but it's about $5,500, and that is all that they would pay to us. With our fees, there aren't additional piddly fees, charges. We just make it a clean one-time charge. Or on the regular forward, we have one additional on the replacement side, but that's it.
That is pretty reasonable, actually.
That is, yeah.
And in Hawaii, do you have to be licensed in some way to participate in exchanges? Because it is, it's a financial transaction. How does that work within our state?
Well, IPX 1031 is licensed to do exchanges here and across in actually every state. So because we're national, but really there isn't any specific designation I have to have. I have a lot of years in, so I like to think I'm qualified. But again, we are leaning on our in-house attorneys a lot of time for support and guidance.
Mm-hmm.
Yeah, and there are some people that have a CES, which is a certified exchange designation, but I haven't gone that route yet. It's a long test.
It's inherent and understood.
Yes.
So.
I've trained under some really brilliant attorneys and
Right.
learned a lot throughout these years.
Now, being that you've seen a lot, and I'm sure you've been in situations where the time is creeping up and somebody can't find a replacement property. They didn't structure it as reverse exchange, so they're bound to the 180 days to close on that replacement property. What are some things you could recommend to that individual?
Ooh, so they're past their 45 days, you're saying?
Well, maybe they are not past 45,
Okay.
but they just don't know if they can make that 180.
Mm-hmm.
So if we have to exchange and we're trying to defer the tax, what's another option?
Maybe they found one or two good properties and they want to have a backup solution or a backup plan if they can't close on what they've identified. We like the DST, the Delaware Statutory Trust. This has been something we've been doing a lot of education on here locally. We see it on the mainland. Investors really, this is something that's been, really well known about for years, but here it's kind of catching on. So this would be a type of replacement property that's available at any given time, as long as you work with a financial planner, and I am not a financial planner, so I can't sell these types of products, but the clients also need to be a qualified investor. So you don't just see these being advertised to anybody and everybody, but a lot of folks that do own multiple investment properties would probably be a qualified investor. And these properties are in places like Texas and Florida and Washington, D.C. And basically you're coming in with other investors and you're going to pick up a small percentage of this property, but it might be like a student housing center or a senior care facility. Could be apartment buildings, but you're one of many investors, and you're going to get about a 5% cash-on-cash return.
Mm-hmm.
It acts just like real estate, so you're able to depreciate it and get all the benefits and maybe appreciation when they go to sell it. But these properties are typically held for a certain real estate cycle of maybe 3 to 7 years, or when they feel the property's gone full cycle, there's appreciation. They sell them off, and then you can do an exchange back into regular real estate or back into another DST. I like to think of it like a REIT.
Right.
But a REIT, you're not getting the deferral, right? You're actually selling, and then you're taking that cash and putting it into a REIT. With a DST, you can exchange in and back out of it. That's why I prefer it.
Right. It's not a security, but it's real estate.
Right.
And that's what makes it like kind
Yes.
and qualifies. So is it similar to what we heard of as tenant in common type investments?
It used to be a
right.
tenants in common structure,
Mhm.
but when the financial meltdown happened, and I was present during this time, they recoined it as this Delaware Statutory Trust, where it's now sold as a security, so you work with a financial planner, but they've taken away the control. You know, a tenants in common, everybody has voting rights.
Mhm.
Everybody has to qualify for the loan, you know, things like that. This is a much better structure because then the inland real estate, that's who I usually recommend because they're the largest real estate company you've never heard of, but they're really good at these DST products, and their investors have done really well with them. They've never failed to pay an investor. They've never asked for money. You know, they provide that steady monthly income. But we work with these kind of guys, and they do a good job at taking care of their clients.
So if you look at how you could actually put this into practice, it sounds like when you're in that 45-day period of having to identify a property, as a safety net, you could identify a DST
Mm-hmm.
as one of those replacements while you're still looking for, you know, an actual physical real estate
Yeah.
holding here.
Yes.
And of course, if you don't find that property, then you have a DST to use, right?
Yes.
Fall back on.
Yeah, you can fall
Yeah.
back on that. Mm-hmm.
Okay. How do you see people using exchanges to maybe benefit, you know, future generations?
Yeah, a lot of folks are using the exchange as a way to estate plan.
Mm-hmm.
So maybe they have one property and 3 children, right? And I've been in the title and escrow industry for a long time, and you do see a lot of children fighting over properties, right? It's unfortunate. But that would be where they're taking one property, selling it. Maybe they're buying 3 replacement properties for each child gets to pick out their own. They're separating the funds out, and eventually that property will pass on to those children when they're one day not here with us.
Right, right. And I heard somebody ask me the question of, well, what if I happen to want to move into one of these investment properties that I purchased as a replacement property? You know, what is there a rule against it? Am I going to violate and, you know, disqualify the exchange? What happens there?
So, you know, we talk about this a lot in our classes, but you can absolutely move into your investment property. There's no rule out there. This is one of those gray areas, right? So sometimes life just happens and people are forced to move into their investment properties, and there's nothing we can do about it for a job change, a divorce, or, you know, those kind of things. But then there's others that pre-plan, and they're maybe moving from the mainland. Their goal is to live here, and they want to eventually move into that property one day and in that 1031 cycle. So what I would say to somebody like that is, you know, definitely rent it out for 2 years. And it's not like it has to be rented for 365 days a year, but the rule there is at least 14 days for 2 years. So 14 days in year 1, 14 days in year 2. They're claiming that income on their taxes. They're depreciating it just like normal. Then they can start the conversion process, right? So they can move into it after they've been renting it 2 years. After they've lived there for 2 years, then it would become a primary residence.
So when it becomes a primary residence, then the status of that property changes. It's not necessarily an investment, but now it's their owner-occupied property.
Their primary, yep. And they would talk to their CPA, and they wouldn't be on the hook for the taxes. They may have to pay a little bit of depreciation. And that's something that they would want to talk with their CPA about before they made those plans. But yeah, it is one way to end the 1031 cycle. And we call it in our classes one way to move into your dream home.
Right, right. And I've seen that happen. In fact, I've also seen it where they move into their dream retirement home, right, where you have maybe there's a couple, they're empty nesters, they have a large single-family property, too big, they don't want to maintain it. Maybe has stairs.
Yeah.
So eventually what they'll do is maybe they'll move out of that, right, into something smaller, but that'll then be rented out, right? And eventually they say, well, maybe I don't want to hold on to this big single family investment, but I could sell that and then maybe exchange it into a couple other smaller investments. And eventually one of those smaller investments becomes that one that they move into next, right? So I guess it depends how you structure it and how they plan it out.
That's right.
So if you were going to say, well, here's some people you can have on your team to help you make decisions on what you should be doing and planning for in the future, what kind of professionals would you say would be good to have on a team to help in this process?
Well, I would say definitely a good CPA
Yeah.
that understands 1031 exchange, right? And it's, you know, they have to know a lot of the tax code, but there's definitely certain CPAs that are really well versed in 1031 exchange. That would be one person, maybe a financial planner if you're thinking about the DST, an attorney. You know, if you have a high, you know, a very complex exchange, or maybe you've got vesting issues that you're dealing with, an attorney could help remedy some of those things before the sale. So that's the things that you can pre-plan for that make it a lot smoother of a transition for everybody and all the family that might be a part of that sale as well.
Right. And of course you.
And me. Don't forget about
the most
me.
important part of the puzzle there of the team. Well, Tiffany, if our listeners wanted to get a hold of you, find out more about the 1031 exchange and how you can help them benefit from this, how can they reach you?
Yes, you can easily reach me on the phone at 808-387-4140, or I can be reached by email at tiffany.davies@ipx1031.
That's great. Tiffany Davies, thank you so much for joining us and for servicing our community with their exchanges.
Thank you.
Coming up next, we have our KupunaWiki Classic Trivia.